Hello, everyone, and welcome to Expert Webcast. I'm Alex Kasdan, Managing Partner of Convergence, and I'm pleased to moderate today's program on understanding exit alternatives for a family-owned business. We received a number of questions from the audience already, which we'll try to address as many as we can, and I would encourage everybody viewing or listening to this program to submit questions to the panel or any of the panelists. With that, we've got a great panel here today. Let me start by introducing Alvina Lo, who is Chief Wealth Strategist at Wilmington Trust, responsible for wealth planning, strategic advice, and thought leadership development for the Wealth Management Division. She oversees a national team of wealth strategists, financial planners, and thought leadership experts, who together serve as advisors to high net worth individuals and families, business owners, entrepreneurs, and foundations and endowments. Prior to joining Wilmington Trust, Alvina was the Director and Senior Wealth Planner for Citi Private Bank, where she served as an advisor to U.S. and international ultra high net worth clients. And prior to that, she served as a wealth strategist for Credit Suisse Private Wealth. And earlier in her career, Alvina practiced law at Milbank, Tweed, Hadley & McCloy in the Trust and Estates Group, and served as a consultant for Deloitte Consulting and Sign Corporation. Alvina holds a bachelor's degree in civil engineering from the University of Virginia, where she was a Thomas Jefferson Scholar. She received a law degree from the University of Pennsylvania, where she was a member of the Law Review and Order of the Coif. She also holds a professional tax certificate in estate planning from New York University School of Law. Alvina was most recently recognized as one of Worth's Groundbreakers 2020, 50 Women Changing the World. She's a published author on estate planning matters and has lectured extensively. She's been quoted in the New York Times, Barron's, and Business Insider. She's also bilingual and speaks fluent Chinese, Cantonese, and basic Chinese Mandarin. Alvina, great to have you on Expert Webcast.
Thank you, Alex. Looking forward to it.
Great. Joe Hellman, who's a CPA, is a partner at Redpath and Company. Joe leads the transaction advisory services practice. He provides support to clients throughout the transaction lifecycle, from evaluating opportunities pre-LOI to post-close net working capital true-ups and synergy assessments of both buy-side and sell-side transactions. Joe has experience assisting buy-side and sell-side transactions across a variety of industries, including manufacturing, healthcare, construction, consumer products, distribution, financial services, technology, and energy. He has provided public accounting services since 2008 and joined Redpath and Company in 2020. Joe holds a bachelor's in accounting and finance from Minnesota State University at Mankato. Joe, great to have you.
Thank you. Look forward to it as well.
Vanita Spaulding is a founding partner of Spaulding Financial. She has more than 40 years of valuation experience, providing valuation services in many industries and to clients in the cannabis industry since 2015. She has a diverse background in a myriad of valuation projects, including allocation of purchase price, ASC 805, and impairment testing, ASC 350, common stock valuation, and share-based compensation valuation, IRC 409A and ASC 718, fairness and solvency opinions, intellectual property analysis, pre-acquisition financing, merger and acquisition pricing, and various litigation support projects relating to partnership dissolution, shareholder disputes, breach of contract, lost profits, marital dissolution, personal injury losses, federal estate tax and gift tax, and eminent domain. She's qualified as an expert to perform litigation support services and has appeared as an expert witness before the Superior Courts of Los Angeles, Orange, Riverside, and San Bernardino counties, as well as the American Arbitration Association. Vanita holds a Bachelor of Science degree and an MBA in Finance from California State University, Northridge. She is an accredited senior appraiser with American Society of Appraisers in Business Valuation and is a chartered financial analyst. Vanita is a frequent speaker on Expert Webcast, and as usual, it's great to have you. Dave Johanson is a partner in charge of the Napa office of Hawkins Parnell. Dave assists clients in general corporate matters and employee ownership benefit, ERISA, and related business matters with an emphasis on executive compensation, equity incentives plan, non-qualified deferred compensation, employee stock ownership plans, ESOPs, ESOP transactions, mergers and acquisitions and related tax planning, and business succession and estate planning. David served as outside general counsel to numerous corporate clients over the past 32 years. He frequently appears on behalf of clients in business and employment-oriented defense litigation in state and federal courts throughout the country before regulatory agencies such as the U.S. Department of Labor, California Labor Commissioner, and the U.S. Equal Employment Opportunity Commission, and tax controversies before the Internal Revenue Service and comparable state regulatory agencies against felony criminal indictments in U.S. federal court and dispute resolutions of various kinds. David represents corporations in shareholder and non-competition disputes. He is nationally recognized for his experience and expertise in the ESOP and executive compensation field. He holds degrees from University of Minnesota and Columbia College in Missouri, and is a frequent speaker on Expert Webcast, and it's always great to have you.
Thank you.
We're talking about understanding exit alternatives for a family-owned business. So let me actually go to Dave as the lawyer on the panel. What are the exit alternatives that we typically talk about?
Thanks, Alex. There's probably a half a dozen different kinds of things you can think of in terms of exiting a business. Going public is probably not an idea that most people can utilize. There's just a few folks that can take advantage of that. But the general basic ideas are a management buyout where you're basically effectively assisting management in gaining access to equity in the business, either in a tax favored manner or just a direct purchase. A strategic sale of the business, as you know, Alex, that's going to result in the greatest possible value for your business, where you find somebody who really wants to own you because of certain features about your business, and that's going to create the greatest value. Financial buyers are abound these days. The private equity groups, that's not going to be as high of a price as the strategic buyer. And then before I talk about my favorite topic briefly, you certainly could gift the stock. There's an exit strategy as a gifting, and I'm sure Alvina can talk about that, the gifting, and so can my other co-speakers. But gifting either to family members or to a charity is certainly another potentially tax favored opportunity for exiting. But the one I've spent my career on is with ESOPs, and I know, Alex, you always give me a hard time that the strategic buyer is going to create the best possible sale, but as the sale to an ESOP has great features for tax deferred treatment for the selling shareholder and tax deductions for the corporation. So that's a brief overview, Alex, of the various alternatives.
Thank you, David. And I'll come back to you on the ESOPs and some of the other things you mentioned. And actually, what we've been seeing lately is financial buyers outbidding the strategic buyers.
Really?
So I'm not sure where the higher valuations come in. Maybe Joe can comment on that later. Alvina, let me go to you. You're spent your time on sort of wealth planning, advising families and business owners. Why does timing matter when it comes to sale and estate planning? And when I look at sort of family businesses contemplating a sale, it's always two prongs. One is shareholders, what do we do on a personal front? And two is let's get the company ready. So let's touch on the shareholders first.
Sure. Thank you, Alex. Yeah, and you're right. Why does timing matter? Right? We always hear the saying, timing is everything. And when it comes to estate planning or pre-transaction planning, when it comes to exiting the business on the personal level, that cannot be more true. Right. So if I may just, take a quick second to talk about what the potential problem is and why timing can be very critical in getting to a better outcome. Right now in the US, if you're a US person, you can transfer up to a certain level of wealth to your children, either during your lifetime or at death, without incurring an additional gift tax or estate tax. right? And so when David mentioned earlier, one of the transition or exit is potentially gifting. Well, I might just add a little bit more twist to that. Sometimes these transitions are involuntary, meaning if you become incapacitated as a business owner or you die prematurely, right? You could be leaving this to your heirs, whether it's a spouse or children, or even grandchildren. And that's when the estate tax could potentially hit. Currently in the United States, the exemption is at $11.7 million per person, or double that if you're married, right? And that includes everything you own, your car, your paintings, your watches, and your business. And I know that that sounds like a lot of money, and it is, right? But if you count everything a successful business owner had, including the life insurance proceeds, you could see yourself quickly getting to that number for very successful entrepreneurs and business owners. And with the ever-changing constant estate tax law, right, that was literally in the Democratic proposal a couple of weeks ago, that exemption could potentially go to half, with $5 million very quickly. So why timing matters is that when you're thinking about gifting or transferring wealth, your most valuable asset, which is your family business, right, you want to be able to gift those assets when the valuation is at this point, before it climbs up to the level where, you know, the other experts here, right, can kind of help us get to this level of the sale point because of the use of the exemption. So if you have a $11.7 million exemption, if you transfer your business when it's worth $1 million, you use up 1 million of your 1127 exemption, as opposed to building your business, getting the valuation you need and selling it, you know, at say a $5 million mark. So timing matters because oftentimes we meet with business owners and they're so focused on their business, right? They're forgetting everything on their own, which is the personal side. And I have so many clients who say, that's great what you're telling me, Alvina, you and your team are making total sense, but I just can't focus on that right now. What I need to do is focus on the business side so I can sell this thing. And I think that's a massively missed opportunities because by the time you do your estate planning, your valuation's already up here and you've missed the entire part of that acceleration that could be held inside a trust, which would be a lot more tax efficient.
Alvina, you brought up quite a few great points. And I tell you, as an investment banker, people come to us and always say, how much can you get me for my business? What multiple can you get me for my business? And we'll get the most multiple, but the question is never, what am I going to net as a result of this transaction? And those could be you could have very drastically different outcomes depending on the planning that you do beforehand. So I do want to come back to that. But let me turn to Joe on the transaction planning side of things. Assuming that we'll take care of all the shareholder issues, estate planning, wealth planning, tax planning, what can we do on the corporate side to make the process run smoothly and maximize that multiple of that value?
Yeah, that's a great question. And oftentimes that's asked probably a little too late in processes. A lot of times, you know, it's all about relationships, trying to build that relationship toward the potential exit. And if you're coming to us asking that question, as you've already, you know, talked about launching a process, you might be a little late. But the more likely you are to have your financial house in order, the better off you are. And what that means is you have a good management team. You have good accounting systems and software. It means you're on an accrual basis. It means you don't have customer concentration. If you have some concentration risks, both on the vendor or customer side, you find ways to mitigate that. You lock them into longer term agreements. Anything you have that can kind of ensure the sustainability of earnings is going to help maximize that value. As far as making the process go smooth, you know, having your house in order is very important, but being prepared is more important on the back end as you've started to start this process. Once you start to get into the diligence phase, once you start to get involved with potential buyers, that's where you really want to understand what the process looks like. Make sure that you know what requests are coming. You have a good advisory team, making sure that you've thought about things post-transition, because all those things are very important. A lot of people don't really think about that until after you're getting into the process. And then, you know, the thing that everyone hears about, deal fatigue, kicks in, and it's very real. Deal fatigue does happen. It kills deals. And the more prepared you are in advance of that, the better off you are and more likely to avoid it.
Thank you, Joe. And due diligence is a big topic, and I definitely want to come back to that. Let me go to Vanita. You're an expert on valuation. And at the end of the day, I guess it all comes back to how much something is worth. And can you talk about different valuations methodologies in helping business owners, families understand what they have?
Sure. Basically, there are 3 valuation methods that are commonly used. The simplest one, and the one that's probably not the right one for a fully fledged business that's been operating for a long time, is what we call the cost approach or the asset approach. Just looking at the assets of the business. There's real estate, there are buildings, there's machinery. People have value, your intellectual property has value. You can value all of those assets and add that up. That's the cost approach. Then there's looking at other businesses that are similar to yours. We call that a market approach. And you can look at publicly traded companies. If your company's big and comparable to a publicly traded company, you might look at multiples of publicly traded companies, like a price to earnings ratio or even a price to revenue ratio, something very simple. But then the most appropriate valuation method, and the method that's appropriate for all businesses, is what's called a discounted cash flow approach. And for that, we generally look at 5 years of historical financial information. We look at their financial statements and historical balance sheets. Has this business been growing over 5 years? Is it declining over 5 years? Is it likely to grow over the next 5 years or decline? What's happening in the industry? How has the economy influenced this business and how it's grown or declined? How has COVID influenced this business? So in 2019 and 20, businesses were impacted by, among other things, by COVID. Some businesses did really well. If you happen to be able to very quickly figure out how to sell masks, you were king. If you were in the grocery store business, you did really well. If you were a garment manufacturer and a garment store, where nobody could go, you did poorly. So looking at a historical 5 years, which is what we've always done, you see this for most businesses. You see that they were growing, and then they had a decline, a COVID decline, and then most of them have climbed out of the COVID decline. So in doing a discounted cash flow methodology, you have to take all of that into account, and then look at what the business is likely to do financially, revenue, expenses, profit, over the next 5 years, and discount that to present value. So that's the third and primary approach to do business valuation.
Thank you, Vanita.
If I may,
Absolutely.
if I may, Alex, you asked me before why timing matters, and something Vanita just said, absolutely is resonating with me about COVID and valuation. I know that business owner always, naturally think about, good times are when the business value is up. But from an estate planner perspective, when valuations are down, that's actually fabulous from an estate planning perspective. Yes. Right? Yeah. So when you mentioned COVID, it reminds me actually of a client that we had who was in the hotel business, and obviously got hit very hard, with the pandemic. And during that time, they actually did some very significant estate planning and transferred their business interest, which is very depressed in value. We're able to basically get a lot of underlying equity that we know will bounce back one day into a trust for the benefit of the children, so that when the bounce back happens, and which it is, because now things are opening up, all that is already sitting in the trust, in a very tax efficient manner. So when you say why timing matters, not only does it matter on the high, but it really also matters on the low. And so working closely amongst the advisors that you see, or the discipline that are represented on your screen today, right, between the valuation expert, the corporate expert, and the trust and estate side, right, like I think is really, really critical.
I think that's a huge point, Alvina. And actually, I was just reading something on, I think it was Bloomberg or one of the publications, saying that the negative impact of COVID and the lockdowns have been very disproportionately high on family-owned smaller businesses. So that effectively is a planning opportunity because the valuations are depressed when you look at that.
Well, it was.
Right.
It was. It's not so much, I believe, because we've come out of it, we've got vaccines, people are going to restaurants again. When you're looking at doing evaluation of a business now, as of today, the next 5 years look much better than they would have if we had done the valuation 2 years ago when COVID was just raging around the world and values were significantly down.
Right. I agree with that. Let me go back to David as a lawyer on the panel. Started talking about ESOPs. And one thing that I've learned as an investment banker representing many privately held companies and family business, that you really have to understand the motivation of the sellers. Maybe very different, maybe legacy, maybe let's maximize the value. I don't want to walk away, maybe sell part of the company. It really is fact and family specific. Why ESOPs versus sale to a third party?
Well, I think clearly what an ESOP that's properly structured can allow the founding shareholders to do is have some kind of involvement in the ESOP and create the legacy as they go. They can do it as a staged transaction. It doesn't have to be all in one. They can be a part of the board of directors going forward, maybe not controlling the board of directors if it's a control sale, but they can be actively involved in the business as the notes that are incurred to buy their stock are cashed out. Also, probably the main reason that companies, in addition to that topic, there's two other main reasons that founders think about an ESOP. One is to try to align the interests of the employees with the interests of the shareholders in the company. And when you do that, hopefully you get a productivity boost and a profitability boost that goes along with that if you communicate to the employees how they can create value. Bring someone in, quite frankly, like Vanita, and educate them about creating value at an ESOP company. Also, the other main reason that founding shareholders think of an ESOP rather than some other form of business succession, Alex, deals with taxes, because you get tax deductions, major tax deductions on the corporate side in a C corporation ESOP. You get, to the extent you've got 100% owned S corporation ESOP, you have virtually no corporate level taxes. So there's those great tax advantages to the corporation that sponsors the ESOP. And there is something referred to as Section 1042, which is a tax deferral provision. And that allows the selling shareholders to sell to an ESOP, reinvest in stocks or bonds. They could monetize it with floating rate notes, take the cash out, and then basically not have to pay any capital gains taxes at that time. The one complication, Alex, that we have with this tax deferral under Section 1042 is that President Biden has a proposal now to tax unrealized gain at death and basically eliminate the stepped up fair market value, which I know Alvina can talk to as well, that used to be available. So that is likely that taxing unrealized gain at death is likely to be part of the new tax law that gets passed eventually. And the problem with that is that selling shareholders then get into a conundrum because they have to decide, do they defer their taxes now? And then all of a sudden they get stuck with having to pay, their estate gets stuck with having to pay capital gains taxes at a higher rate down the road. So the deferral goes away. Or do you just do an installment sale right now or do a sale of the entire company at the capital gains rates now, which may be better than they are down the road? So very interesting question, a lot of choices, and cuts across all the disciplines on this panel, quite frankly.
Mhm. It does.
Thank you, Dave. Well, let's go to Alvina before we go back to Joe. Taxing unrealized gains, isn't that a fundamental change to the tax policy?
It is, and I gotta tell you, I'm a tax professional. I've been doing this for 16 years now, and I have to tell you, I have never felt more like, you know, baffled by all the tax proposals that are out there, what may or may not happen. I honestly feel like I'm on a roller coaster ride with all the twists and
Yes.
turns, and I don't know when the ride's going to end. As of today, right, it's November 18th. We have 7 weeks away from year end, and we don't have actually any clarity as to what will happen or if it's going to happen. The latest proposal that was put out there, which is the Build Back Together Better Plan, the latest proposal being out from November 4th, so that was only a week and a half ago, do contain a number of provisions. And, I just think that a lot of the previous proposal was a very fundamental shift, as David said, the loss of step-up in basis, the billionaire tax, right? That was out for like a whopping 3 days and then it was gone. I think that kind of highlights the fact that, it's very difficult, to plan when you don't know what you're planning for, right? It's kind of like, you're looking for something behind a closed curtain and there's a moving target you don't know. And so what we're doing with a lot of our clients who are rushing kind of to get a lot of the stuff done by year end is what I say is like, stay the course, right? We know what the current law is. I do not believe that the current tax environment is going to get any better for the high net worth and ultra high net worth individual. So to the extent that you're already thinking about doing some of these long-term planning, like putting a trust in place or selling your business, do not let the latest news, cycle kind of get you distracted from what it is. Could we have a fundamental shift in this country on these very kind of core tax laws that David said? It's possible, but don't make any knee-jerk reaction based on what might be. And the last thing I'll say is this, just a history of lesson as of two months ago. For a good while, we really thought capital gains was going to go up, retroactive to September 13th. That was the proposal. And we had a lot of clients here at Wilmington Trust who said, should I sell, should I sell, should I sell? And our advice always has been, steady hand. If you're going to sell anyway, there's no reason not to accelerate, but don't do it just because of what may happen with the tax proposal.
Right.
Very interesting. Thank you, Alvina. A lot of uncertainty and makes your job more exciting, I guess, or interesting to plan.
Job security, I guess.
Right. Let me go back to Joe on the due diligence, and I'm looking at some of the points that you sent to me. What is due diligence? And I find it sort of funny personally. I was a first-year associate at a law firm, and I was told that I'm going in a big New York law firm, and I was told I'm going on a due diligence trip. I said, oh, what's due diligence? Well, you're going to go look at a bunch of things to look for things that stand out. I didn't tell them stand out from what, but that was sort of the explanation I got. And I think, when you deal with many business owners and families that are contemplating a sale, there are a lot of misconceptions of what due diligence is, and there's a lot of interest in understanding how you go through a due diligence. And I spend a lot of my time as a banker explaining that it's not necessarily a negative process. You can actually gain quite a bit of benefit and value in terms of valuation and, driving interest in the company by doing due diligence. But I wanted to get your perspective, sort of self-diligence and due diligence, what the process looks like, sort of best practices, things to focus on.
Yeah, no, it's a great question. It's probably one of the questions I'm asked most from our internal clients. No one really understands what the process looks like on the front end before you go through a transaction, but they always understand it on the back end after you've gone through it, because they realize there's a lot more work than what they originally anticipated. So the first part of it's just, what is diligence? And it can take a variety of forms. It can be on the IT side, it can be operations, it can be tax, it can be financial, commercial diligence. There's a variety of different forms depending on the deal size and the buyer and how sophisticated they are. And the more you can prepare on the front end by going through it and identifying what are they going to be looking for, what are they going to find, how are your financial statements, how's your management team, Do you even have capacity to go through this right away? It's all important because what we're seeing right now is, I guess as we sit here in November, now we're seeing everyone trying to rush to get them closed by the end of the year, right? But if we look back 3 months ago, it was a race to get your business to market and try to get it closed before the end of the year. And a lot of times what we were being asked about on the diligence side is, well, why would I even do this on the front end? Why don't I just have the buyers pay for this? Why would I do it? And you're missing three key things if you don't do it yourself. Kind of the speed to close, the certainty to close, and maximum valuation are the three things that you'd be missing out on if you do not kind of go through this on the front end. Because you're ultimately going through an addition. By going through on the front end, you're going through everything that a buyer is going to be doing. So now you're more prepared. You know where the holes are, you know where the red flags may be, and you're better able to mitigate those and speak to them, knowing that it's not a surprise to you. And part of that process is the self-awareness. Now that you've gone through it, now you know your holes. Now you know your weaknesses. A lot of times as the business owner, you've raised this from the ground up, right? You've started, this has been your life work in many cases. If that's the case, you may not see the flaws that the buyer may see. And that's sometimes hard to stomach.
Thank you.
Joe, let me add to that. One of the assets that I think businesses miss counting in the assets that make their business valuable is the intellectual property. I could list you a long list of what makes up intellectual property, but instead of just thinking about the operations of the business and the hard assets and the cash in the business, think about the trade name and the trademarks that you've developed. Think about the patents that you have, the patents that you have that you may not even be using yet. There are many businesses that have a significant amount of intellectual property that they don't necessarily count because it's not a hard asset on the balance sheet. So companies really need to think about what they have and promote that. If they're looking at selling their business, really promote the intellectual property that they have.
It's a great point. And I want to come back to a couple of things that you just raised, but let me go back to Alvina and looking at some of the questions that came and actually made me think of the first line about Anna Karenina. All the happy families are alike, and every unhappy family is different, is unhappy in its own way, right? And we have to deal with all kinds of families, and it almost sounds like when we have this discussion about, we refer to this family concept as one sort of unified entity with everybody pulling in the same direction, which is very rarely the case, because we may have parents, grandparents, children. Some are involved in the business, some are not involved in the business. Cousins, nephews. Actually had a conversation with a private equity firm that closed the transaction. It took them about 1.5 years to do it. They had 37 family members, all with divergent interests that they had to reconcile. So it's not all that uncommon. How do you get, from your perspective as a wealth management advisor to the families, how do you get everybody on the same page, or at least everybody to agree what the best course of action might be?
A lot of talking, but with help. Certainly when you're dealing with family business, right, you've got a lot of dynamics going on. You might have some people, children, right, that's just, kind of typical family business. You got the patriarch or the matriarch, you have a couple of kids. Some of them are in the business, some of them are not in the business, right? And then when you're talking about a plan or estate plan, whether you're selling the business or you're leaving it, necessarily becomes, well, who's getting what? Equal is not always equal, right? What does that mean? And as a trust and estate attorney, whether it was in private practice or now in a wealth management firm, my team and I almost feel like family counselors half the time, right? It's like, because you're involved with these conversations. And in fact, we're involved with it so much that we actually built an entire practice in my firm around it. And it's about family governance, family legacy planning and hosting these family meetings where we could be the objective third party. Because it's sometimes easier to have somebody who's seen this a couple of times, or more than a couple of times, to say, hey, here are our family values. I'm almost taking a step back and say, here are our family values. What does this business mean to you? Right? And getting alignment on all this. Because, the professionals here can tell you, like, with structuring a trust or structuring your deal, whatever it might be, that's almost, it's not easy because it's very complex, right? But what often kind of gets in the way is the people side of it, the softer stuff that nobody wants to talk about, that nobody wants to think about, and yet it could really ruin a deal or structure at the end hour. So I would say with that, it doesn't come natural to a lot of people because it's a very personal thing. Your business is your family for most of our clients, right? How do you do that? And then sometimes it's just taking the bold step to say, you know what, we need help. We need third parties. We need professionals that we can trust. Come talk to us and how you would do it, and be almost the impasse broker sometimes, right? To get us all to talk about it. There is no magic answer. There's not one structure that's going to work for everybody. But if you don't talk about it, there is literally no hope for success, in my opinion.
Well, I agree with you 100%. And I think that information that you believe is invaluable as a banker running the deal. I worked in transactions where, one of the conditions to a sale was whoever is going to buy this company, financial or strategic buyer, they have to continue employing my two kids that have been in the business since high school. It completely doesn't matter whether they want them or not want them. If they don't employ them and give them titles of senior vice president, the deal is not going forward. Those kinds of things, and you have to be completely cognizant of the dynamics, and the buyers usually are as well, because and there may be value in employing those people as well. It's just because they're part of the family, it doesn't mean that they don't add a lot of value to the transaction. Dave, a lot of questions came in on the ESOPs. One is, when is ESOP the right solution? And do they only work with certain industries and certain types of companies where there's sustainable, sort of repeatable earnings, predictable earnings?
Yeah,
Year in, year out.
I think good question. Obviously, I think I would almost defer to Vanita on the sustainability of earnings, because she can probably answer that better than I can. But I think it's really critical that the company in question, no matter what industry they're in, have probably little or no debt, external debt. And on top of that, the company has a history, let's say a history of 3 to 5 years of profitable years, and a likelihood, projections indicate that they'll probably be profitable for the next few years. Again, you can't guarantee that because you have things like COVID and Brexit and all kinds of external factors. Now in the automotive industries, there's a chip shortage. So you have those issues. But the key, Alex, in terms of doing an ESOP is to not do it. And it's not a panacea to solve problems for a company that's not profitable. The company has to be profitable. It's got to have the prospect of profitability, and it's got to be as little debt as possible. As to what types of companies or what types of industries, there's no one. We've done the ESOPs in the engineering firms. We've done them in professional firms. I've done it in a doctors group in Colorado. Some state laws allow that to happen. We've done it in manufacturing companies. Are good companies to consider doing an ESOP because they have assets, and assets are a good way to get access to capital to fund the transaction if you're not doing simply a selling shareholder buyback of notes from the selling shareholder. So it varies, but I think that covers the waterfront. I'd be interested to hear, Vanita, quite frankly, what you think about what kind of companies typically are more likely to be recession-proof than others, quite frankly.
Well, thank you. I think ESOPs can be a great way for transitioning the owner's ownership interest to the employees. What you have to remember a couple of things, which I know you know. The ESOP has to not be bad for the employees. The ESOP has to be good for the employees. Otherwise, it's just not going to work. Because the goal of an ESOP is to get the employees empowered in owning the business. That's the goal. It is a way to pay out the founding shareholder or shareholders, but ESOP is really looking at all the ones I've been involved in. They were really involved in making sure that the value was appropriate, not too high, that the value gave real value, significant value to the employees, and that it was sustainable going forward. So ESOPs are not easy, and I applaud you for doing ESOP work. It's not the easiest work to do.
And Vanita, one other thing I'm going to say in response to that, and you hit it on the head. It should be the type of company that's willing to share information with the employees, wants to create a participative environment where employees participate in helping establish the value, understanding how to create value, and understanding that now they own a piece of the pie, so their efforts help to maximize the profitability and value of the company. So you hit on a really good point that if you've got a participative environment, you're more likely going to be successful with an ESOP than you would without that. And
yes, I agree. Absolutely.
Thank you, David. I want to come back on a couple of on the valuation, ESOP valuation points. But let me go back to Joe on the process and again on due diligence, because I think it's such a big topic and always, as I said, always quite a bit of interest in that. What are the common pitfalls you see in diligence?
Yeah, so it can be a variety. It really can be as simple as just having poor accounting and not having the right team in place, or the management team not wanting to stay on, but they own all the key relationships. That's going to be a huge pitfall. They expect that they can transition day one, and they're the ones that are controlling all the vendor and customer relationships, because that effectively is the business that's not going to continue. From a financial reporting perspective, you've never pulled together accrual-based financials, or you've never pulled together monthly financial statements, you aren't ready for a process. You're not ready to get a higher valuation. You can still sell. Those businesses trade all the time, but they're not going to trade at a higher multiple that they may want, because the business is not ready to go. So a lot of it comes back to that prep conversation we had before. People thinking that it's an easy process, expecting it to go quickly, and expecting, in a lot of cases, it's a lot of times a proprietary deal where someone approaches you because you have an attractive business saying, oh yeah, we can close in the next few weeks. We'll move very quickly. You just satisfy the things we have on our list and be done. And most of the time what happens, that request list comes, it's a pretty standard diligence list across all the different services that are being offered by providers. And they look at it and say, well, this isn't quick and simple. This isn't what you expected or what I expected. And in all those cases, the fatigue starts to kick in early. So the pitfalls I usually see are just not being prepared, not being ready to go, your financials not being ready, not thinking through the full transition, coming back to everything we've talked about so far in the transfer of wealth. If you haven't prepped to have that management team or have people ready to go, if you haven't thought about, are you willing to stay on for a couple of years to help transition this business? Those are all things that I see killing deals very quickly. The other piece of it's going to be time. There's a cliche out there, but time kills deals. The longer they go on, the longer it takes, the more fatigue that kicks in.
That's a great point. And the only thing I would add to that is that advisors, or certainly investment bankers at least, hate surprises, right? There's nothing wrong with having something negative, negative factor about a business. But if business owners disclose it to the advisors beforehand, we could spin it the right way. We could perhaps even do something about it to where it doesn't appear as bad or perceived badly by the potential investors. By having it brought up for the first time ever in a management presentation or in a due diligence meeting is really bad, because we have no time to react and have no time to really do anything about it.
Yep. I was on a call with a private equity firm this week where a question was asked of me, and I said, that's actually new to me. And I was on the sell side. I was representing the sellers in that case. And a comment was made that had any of us known about it, it would have been a negative adjustment, would have been something that we would have put into our models. And we asked the same types of questions multiple times and we had a different answer. So you can't plan for those. And that's the important part of the preparation stage, and having good advisors, making sure that you're all on the same page, making sure you understand that you're on the same team. As much as the job is to be objective and credible in my shoes, you still are able to prepare and get ahead of it and attempt to maximize your valuation.
Right. Yeah, no, that's absolutely correct. And also, there's so much information nowadays that potential investors are getting from sort of non-company channels, social media, Facebook, Twitter, everywhere else, from employees, that you got to be prepared for all those things as well. And it doesn't have to be very big companies where there's quite a bit of information floating on the internet.
Yep.
Let me go back to Alvina, the estate planning issues. You have mentioned setting up a dynasty trust. Can you expand on that a little bit, and also talk about the role of trustee and how you get one and who that should be?
Yeah, sure. So a dynasty trust is a very effective and popular strategy, which, by the way, had also recently come under attack with the latest kind of tax proposal. But I'm happy to report that it's off the latest proposal. It's still very well and alive. And in fact, people should really consider it before it goes away, if it goes away. But basically, it's a trust that by its term talks create dynastic wealth, right? So we have a lot of business owners, oftentimes second or third generation, who would put their asset, whether it's a portfolio of marketable securities, real estate, or their business, into this trust. And this trust literally, if you put it in the right jurisdiction, like Delaware, for example, can last forever, hence the word dynastic. And because it's held in a trust, and if it's properly structured, at each passing of each generation, it would escape the transfer tax system. That's the estate tax and also the generation skipping tax. Each, by the way, at a very high level of 40%. Okay, so that's the value of doing this trust, right? So we talked about maximizing value. Well, that's maximum value as a transaction, but if you're talking about dynastic wealth or wealth for your family, you also need to think about this other tax that can hit once the wealth goes from one generation to another. On your point of trustee, Alex, that actually is the question that gets asked all the time, right? People inherently understand the tax benefit. They understand they want to transfer out, but who's going to control it is the thing that matters, right? So business owners are master of their own domain. They are really good at their business that they built, right? Are you kidding me that I'm going to put my money or my assets into a trust and have a trustee or somebody else manage it without me? That's often a non-starter. The issue of control is often the most important thing. Again, it's the who that matters, right? So when it comes to trustee choices, right, obviously you want somebody who, and whether it's an individual or institution like a corporate trustee, who not only knows how a trust is run, right, but understand it, but also that you can trust. And what's really great, especially with business owners, that there are some states in this country, Delaware being one of them, that basically bifurcated your trustee responsibility such that the investment over the trust, i.e. the control of the assets in the trust, your business, can be controlled by the business owner himself or herself. That is not something that's available for all 50 states. You have to be in the right jurisdiction to do it. And what I found is when we explain this to the business owner and have them understand that you could kind of separate the management of the business and the tax and equity side, that really helps, right? Because what the business owners do, like they understand the tax benefit, but they don't want to give up control. And so there are definitely, by your choice of trustee, by the structure of your trust, you could do it in such a way that the business owners still maintain controls over the most valuable asset, which is the business.
Good point. And the company itself doesn't have to be a Delaware company. It's the trust that has to be a Delaware, correct?
Yeah, so if you end up being in Delaware for the trust, absolutely. So we have lots of clients, for example, who have their companies all over the US, some even internationally, right? It's held by a dynasty trust at the top, and then the LLC or the C Corp, S Corp, whatever the company structure is. Sometimes we even form a holding company, right, that owns a portion of the business, right? Because this is an all or nothing. Most business owner only transfer a small amount to start, right? And minority interest into the business that represent the underlying equity, but not a controlling share. So you could form a holding company that usually is in Delaware, but doesn't have to be, that's ultimately held by a Delaware trust.
Great. Thank you, Alvina. Let me go back to Dave. On the ESOP again. We are in the frothiest M&A environment, or the strongest M&A market, I think, if not ever, certainly in our lifetimes, I would venture to say. Valuations are very high, certainly a seller's market. So back to your point that you're probably going to get a higher valuation in the sale to a third party, strategic or financial or either. Versus an ESOP, can you recoup, or how much of that differential can you recoup by the tax benefits that you getting from an ESOP?
Well, again, it depends upon how, a good question, Alex. It depends upon how you structure the deal. But if you do a plain vanilla Section 1042 tax deferred transaction, and you happen to be lucky enough to be a California resident, like I am sometimes, you can end up paying taxes at a higher rate than most everybody else in the country, unless you're in New York, of course, where Alvina is. And so in that situation, if you structure the transaction properly, you can, under current law, defer your taxes to the tune of circa, if you talk about 23.8% on the federal level with the Medicare tax of 3.8, the surtax of 3.8%, and then you talk about a California marginal tax rate over 10%, you're talking about 35% tax savings. So it is a substantial tax benefit. And under current law, Alex, you can buy floating rate notes, hold those floating rate notes until death, monetize and get your cash out of those floating rate notes. And then if you hold those until death, you get a step up in basis at death, and then you avoid the taxes altogether. So it is and that's just from the seller side, Alex. So that's the seller side benefit. You also can have the corporation pay for that tax, pay for that stock that you sell to these up with pre-tax dollars. So there's a huge corporate tax advantage as well. But again, if President Biden's law on the step up goes away, then you're going to potentially have that issue of that it's a real tax deferral and not a complete tax avoidance as it could be set up right now. So that's the offset. And I think you have to look at other things, Alex, not just the taxes. And I think Alvina said that at the beginning. It's good to save taxes, but make sure you're doing it for the right reasons. Is it a legacy issue? Are you trying to improve the morale of your employees and get the employees aligned with your interest in growing the value of the company? So there's an employee benefit aspect to it and a legacy aspect. So don't just do it for taxes, but that can offset the frothy market that you're talking about, and pretty substantially, Alex. It's something to seriously consider when doing an ESOP.
That's a great point. Is there a way to set up a management incentive plan outside of an ESOP to where at least you're retaining key management and maybe passing, or perhaps even setting up a slow business transition?
Yeah, there is. And there is, Alex. And that I strongly recommend for all of our corporate clients and the founding shareholders that we work with, that they not only set up a broad-based employee stock ownership plan when they're doing that as the primary business succession tool, but also reserve, 10-15% of the equity of the business. And you can do it in a tax favored manner as well. There are all kinds of ways, just like you do in estate planning, where you can get stock to the management employees at the lowest possible value with restrictions. And then hopefully it springs up in value at the right time where they can get some incentives down the road. So I like to align management's interests with the interest of the employees, slice off a piece of the company, 10 to 15%, and make it available to the management, because otherwise they're not going to get behind the broad-based ESOP concept, Alex.
Agreed. Thank you, Dave. Let me go back to Joe. You're in the frothiest M&A market, as we just talked about. All the financial buyers, or many of them, are talking about proprietary deal flow, proprietary process, finding companies outside of an auction process. Talk to investment bankers. We love auctions because that's the way to maximize value. What are you seeing out there? What is the difference?
We're seeing a little bit of everything from our client base perspective. Being at a traditional CPA firm, we have audit and tax clients that are being approached on a regular basis, in most cases by financial buyers in a proprietary setting. In almost all those cases, they're being promised very quick closes, high multiples. And what most of them are looking at is we maybe did a valuation for them. They may be an ESOP and we did an ESOP valuation. We maybe did an estate plan for them. And they're seeing that valuation done for a very different purpose and looking at it saying, oh, this is great value. You're right. You're giving me an awesome multiple. But there's a huge disconnect between those types of valuations and a street price, a broad auction process. So we see that happen a ton. It's probably one of the biggest challenges we have trying to explain what the purpose of the valuation work we did was compared to what would it look like if you did a market approach. And in the market approach, you're going to be under scrutiny. You're going to be looked at a lot more. There could be multiple parties coming at the same time. So then you're going to have, you're going to be distracted. You continue to operate, but it's all a challenge. It's a matter of what do you want? What do you want for your team? What do you want for the management? What do you want for your legacy, as been talked about quite a bit. But the goal of it during any of them is if you get that price up front, you want it to stay. What you don't want to have happen to someone retrade. You don't want someone to come back to you and tell you, well, we were going to give you this amount, but because things aren't as good as we thought, now we're going to pay you this. That should be the goal of every transaction, to avoid that. And it's easier said than done.
Agreed. And a market approach could be very different than the one-off offer, even though it may look great on its own, but it's really hard to evaluate. An apple is only worth what somebody's willing to pay for it. And if there are a lot of people looking to buy that apple, the price is going to go up.
And Alex, if I may, and the other party that you don't want coming in questioning your valuation is the IRS. Yeah. Right? Because, and I've seen this so many times where you have all these valuation floating out there, exactly to your point, Joe, because they're done for different reasons, right? And so if you're going to end up doing a gifting transaction, you don't want a valuation out there that's valuing it this high. But guess what? If you're selling it, you do want it at that high. So one of the, and especially if you're the audience listening out there who have multiple owners to a business, you got to do this thing together. Right. So I actually worked with a family once, or actually a company once. There was it was actually a private equity firm. And they basically required all the partners to do the gifting at the same time using one valuation firm. Because you can't have different valuations out there for different purposes at different times. Because then the IRS is going to come in and say, well, wait a minute, you're a partner and you just gave up 2% of your interest and you put it this number. And then somebody else just filed a gift tax return and said it was at this number, right? So I just cannot emphasize enough the need to get everybody coordinated here, because it could really run in trouble. There's some silent parties out there that you're not aware of, like the IRS, that you need to watch out for.
And sorry to interrupt, Alex. I also have to say the same thing, Alvina, with the U.S. Department of Labor. If you've got an estate tax valuation and then you try to sell your business at fair market value to an ESOP, you might as well say, okay, U.S. Department of Labor, come in and tell me that I violated ERISA and sold for more than fair market value. So great point, Alvina. Sorry to interrupt, Alex. Just
huge points. And we are actually unfortunately, almost out of time. Got a couple of minutes left, and I want to give each of you an opportunity, each of the speakers an opportunity for any closing remarks, perhaps touch on an issue, just as Alvina did right now, on something we should have brought up here, or perhaps something something that we talked about. Alvina, how about you? Anything else?
I would just leave with what I said first. Timing is everything.
Thank you. Joe, how about you on the process and transactional side?
Yeah, really, it's going to be one of the biggest decisions of your life. Make sure you take the time to prepare and think about what's really important to you.
Thank you. Vanita, on the valuation side of things?
As a valuation person, I think one of the most important things to do, because you've got multi-generations involved, is maybe with your attorney involved, have a family meeting so that the family understands what's going on. The family has a sense of that their parents or grandparents are trying to do the right thing and that they're involved. I don't see much of that happening. And I think that's a shame because down the road, one of the kids is going to get pissed off, excuse me, and there will be lawsuits or even just disharmony in the family because that step was missed. So I think that family meeting, maybe, we're in the attorney's office, so everybody's talking. I think it's really important.
Great. Thank you, Vanita. How about you, Dave, as the lawyer on the panel?
Just quickly, and I think you need to involve the types of disciplines that are on this webinar, quite frankly. I'm impressed with the breadth of knowledge that I've heard sitting there listening to my co-speakers today. So get the right kind of team behind you to help you determine the feasibility of whatever method you're going to use to sell your business, and then create a plan and work the plan. And when you're doing that, do some preliminary valuation work, either on the high side or the low side, to figure out which direction you're going. If you're doing estate planning, you're obviously looking at one idea. And if you're doing a sale to an Esop or a sale to a third party, you probably want to know what the range of value of your business is. Put together some good projections based upon contract backlog, et cetera, of the company, and establish a valuation with an expert like Vanita before you do the deal, so you really understand where you're at. And I will say one other thing, Alex, briefly. We just prevailed on behalf of a client that we didn't set the Esop up for. We prevailed in a 7-year Department of Labor investigation and litigation in the District of Hawaii. And that's a blueprint. That case, quite frankly, and the court's decision in that case is a blueprint for how to avoid pitfalls on the regulatory side when doing an Esop transaction. Thanks for the time. I've really enjoyed the speakers here today.
Thank you, David. Congratulations on the case. That should make for an interesting panel, actually, or discussion.
It should, Alex. I think it should.
I want to thank everybody. And from my perspective as a banker, I would encourage everybody contemplating a sale or transfer of family business interests, just to ask questions, talk to people, formulate a plan. And it's a once in a lifetime opportunity or transaction, and make sure you investigate and get the right advisors in place. With that, I would like to thank everybody, Alvina, Vanita, Joe, and Dave, for putting together a great presentation, and we are adjourned.
Thank you, Alex, for hosting.
Thank you. Yeah.
Thank you.
Thanks,
Well
everyone.
done.
Bye-bye.
Thank you all.